Welcome back to the Bitcoin economy. We have Alex Blume, CEO of 2Prime, an asset manager on site that is very relevant to what we're doing here at the Bitcoin economy, focusing on financial services and putting your Bitcoin to work. Alex, welcome to the show.
Thank you for having me.
So, want to break down a little bit about what you guys are doing. I think one of the best ways, the exciting ways, is you guys just announced you're doing an expanded partnership with Marathon Digital or Mara, and can you walk through a little bit of what that partnership is and how you're help putting their Bitcoin to work?
Yes, as much as I'm allowed to share, I can share. High level, I run an asset management firm. We're a regulated, registered investment advisor, and then we also are, what I'm aware of, the second largest Bitcoin secured lender in the world. We've done about 1.5 billion of loans over the last year and a half. So that's what prior we've done loans with Marathon where they send you Bitcoin and then we lend dollars out, and the Bitcoin just sits there and doesn't get traded or reused in any way or rehypothecated. It just sits there, and then when the principal is returned, the Bitcoin gets returned. We also, our core business is around asset management. So we work with institutional holders of Bitcoin, and we trade derivatives algorithmically in order to generate more Bitcoin for clients. So we measure our performance and how much more Bitcoin do we make people, not how much more dollars. And similarly, like if the price of Bitcoin doubles, but we don't make people more Bitcoin, we don't get paid any special fees or anything. So we work with a number of miners and other large holders of Bitcoin, manage on that under yield strategies about $500 million. And yeah, I mean, we can get to the details of how we trade, but basically just focused on consistent, like reliable yield on Bitcoin, which is very difficult to monetize. It's not like a productive asset, it doesn't have cash flows. And so one way to make money off of it is to trade it to generate more Bitcoin, or you can sell it into dollars or whatever. But that's what we're doing for Mara.
Yeah. Super interesting on the side of, you're doing lending and you mentioned you don't rehypothecate. And then there's always, I think, skepticism we've seen on the yield piece, right? You're talking to a lot of people, say at a Bitcoin conference, that are all about HODL, all about cold storage, which are all great things to start with. But as you get into the world of institutional finance, people are going to want to see some type of return on their asset. Any asset, you're holding treasuries, you're getting a return. It encourages more people to put capital into Bitcoin if they can achieve some type of yield. What is maybe, if they explain like I'm five, or what are maybe some of the common misconceptions about how to approach Bitcoin yield?
Well, I think there is. I mean, nothing is risk free. Everything, if you're making a ton of money off something, it's because you're taking some kind of risk or you have some unique alpha. Uh, there's risk to cold storage. People lose their wallets all the time, or they forget their keys, or they get wrench attacked. Like everything has risk to it. We can mitigate risk through being, it's not like using assets to generate yield is like something new. Like it's been around in traditional finance, and there's responsible, predictable ways to custody assets. So, our company, we use Fidelity custody. And so the Bitcoin is in, a huge company that, if they lose the money, they could probably cover it, and also has the highest level of security. And so that providing people wallet addresses, and having, just normal financial controls of multiple sign, like no one person can move money in the company, things like that. Those are the basics, I think, of how to get your head around, like, not my keys, not my Bitcoin, which I think is a totally reasonable way to be. Like, it's just a weighing of values and risk reward. There's no other asset where people would own $5 billion of it and just sit it in a bank account and do nothing. There's a huge opportunity cost to that. And so what we see with institutions is, yeah, they're looking for ways to treat it responsibly, but they need to put it to work, especially these corporate treasuries they're in competition now. And they need to show, like, we're doing something extra with our Bitcoin that is beneficial to share owners. And so, there's other ways to make yield. Like there's Bitcoin staking protocols. I've found institutions are like, no way are we going anywhere near anything decentralized at this point. You're already in a risky industry. You're already like in a high volatility stock. Like we're not going to add this DeFi thing we don't understand. Not to mention there's a lot of compliance and regulatory things that make it very difficult to do. And so, in the way we actually make yield is through, I can get a very complicated explanation or a simple one, but basically um, mean reversion and trend strategies that complement each other such that the net return is a high sharp predictable yield. We're not trying to make like double people's Bitcoin stack in a year. We're targeting like 10, 15%. Last year we had an exceptional year. We did over 20% for most of our clients. But yeah, it's boring. It's like just compounding 10% per year for 30 years is not boring. Actually, that's insane. Yeah. But it's not like altcoin madness or something like that.
And do you see, like, as this becomes, more like adopted on the side of, and like more, I think, trust built on the side of getting yield, you'll see more adoption to the institutional side, being able to park capital. If you're able to, like, if they can say, hey, there's not as much opportunity cost because you're not worried just about asset appreciation, we can also look at this like some yield strategies.
It's not just yield, right? It's if you look at like oil and energy companies, they make oil and then they trade derivatives not just to make more oil or more money on oil, but to also hedge downside. And so, you can use derivatives for a lot of different stuff, but having predictable cash flows where it's like, okay, we mine at whatever, $50,000 per Bitcoin. Well, I can guarantee through derivatives that we will always like have that much from our production of new Bitcoin. We can guarantee a price floor greater than our cost. And so I think right now there's still this like gold rush, like as much Bitcoin as you can, and like the riskier strategies and higher returns. It's like altcoin season on public stocks. Yeah. However, I think we will see the industry mature into like responsible hedging and predictable cash flows. And like, yeah, it's great to have crazy returns, but not if you got a business at the end of it. And so I think there's different market participants in different parts of that risk profile. But yes, as these things mature, yield and hedging, we'll see capital more easily able to invest in companies doing this stuff.
Yeah. And you mentioned like leverage Bitcoin equities, Bitcoin treasury companies have obviously been a hot topic. And people have made that comparison where it's like the altcoins of this cycle are going to be these different publicly traded equities that you can get options on and you can trade derivatives on directly. So we're looking out for announcements this week. What are you looking out for? Like, what are the big things out of this conference you're looking to take away?
Oh, I mean, I think that for us, it's some of it's like infrastructure. Just how can we create regulated, predictable ways for institutions to actually participate? That like it's not just can you make me yield? It's can you not screw up my taxes? Can you give me the reporting my accountants need? Are you SOC 2 certified? Like there's so much you'd be surprised. Like 90% of the sale of a client has nothing to do with the yield. It's like all these regulatory protections that these companies need to satisfy. And I spend way more time than I'd like to, like making sure we're compliant and reporting correctly and audits from the SEC. So we're always looking for better solutions from an infrastructure perspective. And with these corporate treasuries, it actually gives me a lot of concern. I think they're in competition with each other, and they're going to go further out on the risk curve. They're going to take out debt at less and less attractive rates. And like, yeah, MicroStrategy can get 0% debt, and even they can't really do that as much now. But other groups are going to take up loans where the Bitcoin does get liquidated if they can't satisfy the loan, or there's different ways these deals can be structured. And I think that it is the highest risk thing to this cycle is the collapse of the poor performing Bitcoin treasury strategies.
Yeah. Execution is big, I think, in any idea. Well, Alex, really appreciate you coming by. We're excited to follow this more as we dive deeper into Bitcoin yield. And we're always looking to like find partners and to dive into how they're doing it, the partners they're working with, the strategy they employ. I think it's going to be a fascinating part of like taking Bitcoin to the next level of an asset class. So thank you.
Thanks. Good speaking with you.